So, you've been living the rat race your whole life. You are sick and tired of having to wake up early in the morning to work a job you hate and would rather shove shards of glass into places rather than deal with your coworkers. Yet, you do this because you want that paycheck. After all, there's rent to pay, car payments to make, utilities to take care of, food to buy, and entertainment to enjoy. That all costs money. But what if I told you that you can build a portfolio that will help pay for most or all of these things, so that you don't have to work anymore? For most people, that is the name of the game, and in this video, we'll explore how to do just that so you can escape the rat race of life. Understanding your financial goals. Before we can start building that portfolio, we need to establish what our goals are. The best practice is to establish short-term, medium-term, and long-term goals. Give yourself milestones that you want to hit within a certain time frame. An example would be that you want to hit $100 a month in income in 1 year, $750 a month in 5 years, and then $2,500 per month in 15 years. These are simple guidelines, so don't base your goals off of these examples. Instead, think about what you will want to do in a certain number of years, and figure out what income you will need to achieve that goal. Then, work your way backwards and establish consistent habits that will help you get to those goals. One thing to keep in mind is your risk tolerance. Risk tolerance is a major part in investing and should never be overlooked. When you are establishing your goals, be mindful of your risk tolerance. If you have an aggressive goal, but your risk tolerance won't allow for you to meet said goal, you might need to scale back to better coincide with your tolerance. Building the foundation. Diversification. Now that we've established our goals, we need to start figuring out which investments we want to get into. First, we want to make sure that our portfolio is generating income in almost any economy. We also want to make sure that we don't take on a huge amount of risk. The best way to mitigate risk is by creating a portfolio that is well diversified in assets. That way, if one investment goes down, it won't drag down the rest of your portfolio. Now, you might be wondering, what is an asset class, Doc? Great question. An asset class is a group of investments that are similar in characteristics and behave the same within the market. There are 4 main asset classes that are broken down further into subcategories: cash, equities, fixed income, and alternative investments. Cash and cash equivalents is the least volatile and least risky investment, so it doesn't return a lot of money. Cash and equivalents typically include money market funds, cash, treasury bills, and term investments. These are also typically backed by the institutions issuing them, so there is little risk to the investor, hence the low possible return. These also tend to be the most liquid. If a need arises and need funds quickly, cash and cash equivalents can be converted for your use in as little as 24 hours. Equities are the second kind of asset class you can get into. Think stocks, shares, and trading on a brokerage account when you think of equities. The return can rise and fall with the performance of the stock. Many stocks also produce dividends, which are highly desirable for an income-based portfolio. Many different mutual funds and ETFs also invest in stocks, as well as have regular payouts, making them easy choices for diversification and income generation. Equities tend to be more volatile, since they are based more on performance and the economy as a whole, and aren't guaranteed by the companies. Fixed income is the third main asset class. Fixed income consists of debts or bonds that a company or government will issue to raise money. Investors put the initial principal amount up at the beginning, and the entity issuing the bond will pay out interest for the term that the bond is issued. At the end of the term, the bond matures and the investors are repaid the principal back. They aren't as volatile as equities in terms of pricing changes, but the income they provide is more predictable, making them a less risky option over equities. Alternative investments are the fourth kind of asset class. These are more of a catch-all asset class that doesn't fit into one of the aforementioned classes. These can include real estate, commodities, peer-to-peer loans, crypto, among others. The risk levels for these can vary greatly, so be sure to research before getting into these. Now that we have the 4 asset classes, you might be wondering how to allocate your investments. Again, this is going to be based on your goals, time horizon, and risk tolerance. As you age, your time horizon will get shorter, meaning you'll have to explore less risky options. If you're young, you can get away with higher risk investments if you have the stomach for it. For a more conservative portfolio, you want to lean more towards fixed securities, about 60% of your portfolio, with 30% for equities and 10% for cash equivalents. For a more aggressive portfolio, flip the equities and fixed income around. If you need help, talk to a licensed professional. Building blocks of an income portfolio. Now that we've established our options for what assets to get into, Let's dive a bit deeper into what a potential portfolio can look for you. Dividend stocks are probably the most common way to build out investment income. There are many different companies that pay out a dividend either quarterly or even monthly. Many of these companies are strong, stable companies such as banks, healthcare, food, and utility companies. Do keep in mind that no company is perfectly stable, so don't think your portfolio is protected from losing value. That said, these companies tend to be stable given their longevity and diligent management. Bonds are also a very common investment for income portfolios. Bonds that are issued by governments are very secure and stable and will provide a steady income. Companies can also issue bonds to help raise capital, but don't necessarily have the same backing as governments. That said, they can provide a good source of steady income for you. Real estate investment trusts, or REITs, are another common asset for generating income. These trusts own many different types of real estate and pay a portion of the rents or leases to the plan holders. If you own a part of a REIT, you will be getting steady income from them, as everyone needs to pay their lease or rent. Creating your income portfolio. Now let's get to the good stuff, how to build your portfolio. If you need help with this, I will again recommend speaking to a licensed professional to help you out. If you want to take this challenge on yourself, you will need to start focusing on which asset class you'll want to focus on first. Depending on your risk tolerance, try to get a variety of fixed income, equities, and cash equivalents in your portfolio. You may need to open different accounts at a brokerage firm and bank to facilitate this, so research your desired firm to see what they offer. Research your desired investments that you want that will help you gain the income you need. If you don't have a need for the income right away, I'd recommend having the payouts reinvested to help further bolster your holdings. Depending on what your risk tolerance is, I'd recommend a good mix of dividend-paying stocks, bonds, and cash. If you're up for it and have experience and the risk tolerance, real estate is another good option to look into. Once your holdings are purchased, take the time to readjust your portfolio once a quarter. We don't want our portfolio drift into an allocation mix that doesn't align with your goals and risk tolerance. Make sure to readjust your portfolio by reallocating funds to different assets as needed. To further build your portfolio, I'd recommend investing a little bit of your paycheck each week or every other week, up to 20% of your income. This will ensure that your portfolio will build up in a steady pace. It can help take advantage of different discounts on investments. Finally, I'd recommend you speak to your local accountant or tax expert for advice on how to effectively manage for taxes in the event you sell or receive income. They will guide you on how to maximize your returns and pay the minimum amount of taxes required. Building a portfolio that will provide you a steady income stream is no easy feat, especially if you are working with little to nothing. That said, with proper planning, consistency, and discipline, you will grow a portfolio that will provide you with income well into retirement. Be sure to research thoroughly, adjust your portfolio as needed, and seek professional advice when needed. If you enjoyed this video, then you'll love my video on how to earn $1,000 per month with dividend stocks. Thanks for watching, and I'll see you in the next one.